discussing about mutual fund, investment, savings, stocks, everything. So watch our channel till the end so you will get a clear idea about all these concepts. So first thing I would like to ask you is, what are savings? So what usually everyone does is, whatever income they are getting, they are deducting the expenditure, then they do the saving. It's not correct. That's not a correct rule. So whatever income you are getting, from that you have to save at least 20 to 30%. Then what remains, 70 to 80%, that you can keep it as the expenditure for your monthly expenses. So for example, if you are getting 1 lakh as a salary or income or whatever from any other sources, so from that 1 lakh you have to save at least 20 to 30% of it. That means 20,000, and remaining 70 to 80,000 you can spend it for your monthly expenses, because everyone needs the monthly expenses to be bear. But savings is also that much important as the expenses, because if you don't save today, then your future will be uncertain. So you have to save your money at least 20 to 30% from your income. So now next comes where to invest. Like everyone, what they do is, usually in investment means you will put it in the savings account or bank FD. Everyone, if you ask, they just say that I'll invest in FD, I'll invest in savings account, that's it. So but whatever returns you are getting from the savings account or FD, whether it is beating the inflation or no, they don't check. They just think that okay, their money is safe and they're getting the good returns, that's it. But as a investment, as an investor, you have to think whether you are getting a good return from the investment what you are doing, and whether it is beating the inflation or no. So and there are many other financial products, like one is savings account, bank FD, and the another one is that everyone likes, which is gold. Oh my god, Indian peoples are very much fond of gold. Yes, you do have to invest in gold, because the gold ornaments are required for the festival and everything. But okay, to some extent you can invest in gold. And then comes the real estate. Yes, you have to invest in real estate because you need a home to stay. But it should not be too much, because nowadays the real estate market has come down a lot. And okay, then next way to invest. Next investment will be either in stocks or mutual fund. So what is the difference between the stock and the mutual fund is, in the stock, as an investor, you have to keep an eye which stock is going up, which company is coming down, and you have to keep an eye on the market. But as in the mutual fund, there will be a fund manager who will be looking after all these things. Like you need not have to worry. You just have to keep the money, invest the money, and the mutual fund manager will look after all your investments. So come, let's watch in the video what all things will come and how to invest, what all schemes are there. We'll discuss in the video. Thank you. So before I start, let me introduce, I am Hema Hosur, MBA in Finance stream. So what is mutual fund? So now you have decided to invest and you want to have some knowledge about mutual fund. So what is mutual fund? Mutual fund is an investment vehicle made up of a pool of funds collected from many investors for the purpose of investing. So there will, like we want to invest in mutual fund now. So there is an investor. So we are the investors. There is a fund manager. So when you invest in mutual fund, there will be a fund manager who will collect the money from all the investors, and in return he will invest in the securities. Securities is nothing but the share market or the stocks. Okay, what will happen is, in return these shares will generate the returns, and that return will be passed back to the investors. So it is nothing like a parent and a child. So here the investor is a child and the fund manager is a parent. So up to some age, how the parent will be looking after the child, in the same way the fund manager will be looking after your investment. So he will be undertaking the risk and he will be managing your money. There is another one option where the investors can directly invest into the securities market. So that is nothing but investing in the shares of a company and you will become the shareholder of that company. But for that you have to do the analysis, which company is good, whether the financial statement is correct or no, how is the company's growth, everything you have to study. You should be upgraded with all the financial system of that company. Like for example, if you want to buy a phone, what you do, we first do the analysis which company is good, right? So Samsung, you do the comparison between the Samsung, then MI4i, then Oppo. So you'll compare all the phones and then you will select which one is good. So in the same way here also, if you want to invest directly into the stock market, then you have to do a lot of analysis. So if you don't have that much patience or that much time, then you can directly go for the mutual fund investment, where the fund managers will look after all your investments. Okay, so here by investing in mutual fund, you could diversify your portfolio across a large number of securities so as to minimum risk. So if you invest in mutual fund, as I told you, your risk will be minimized. If the market goes up or down, it doesn't matter, as the fund manager will be there who will be looking after your investment. You can see the graph here, how that step by step your money has grown. In the same way, it will grow if you invest in mutual fund. So if you want to invest in mutual fund, there will be some goals. Simply we won't invest. So based on the individual's goal, we have different types of mutual fund schemes. Okay, so some of them are depending on the investment objectives. Funds can be broadly classified in the following 4 types. First one is aggressive growth. Aggressive growth means growth seeks to achieve high returns. However, the portfolio will consist of a mixture of large, medium and small sized company. So here it is almost 100% it will be invested in the equity market. Okay, so in equity market, if it is invested, then the returns will be high as well as the risk will be also high. So this option, it depends on the individual goals. Okay, so one is aggressive growth and the next one is growth and income fund. So some investors will be there who doesn't want to take too much of risk. So he has a mix of goals. So that is called as the balanced fund, where the fund manager will invest 70% in equity and 30% in debt market, or 50 in equity and 50 in debt market, depending upon the company which you have chosen. Okay. So what is debt market now? So debt market is nothing but they invest in bonds, debentures, commercial papers. So these are the debt markets where the returns will be less compared to the securities, equity market. Okay, so this is a balanced fund. Next come the investor who wants the fixed income. He doesn't want to take any risk. So it is same like an FD. So in this fund, we generally invest in number of fixed income securities. This will provide you with regular income. So how in FD you will be getting a regular income. So in the same way, here also you will be getting a regular income and it will be invested 30% in equity market and 70% in debt market. So here you will be receiving a regular income, and mostly the retired people will take use of this type of fund because they don't want to take much risk as their age has been come to some extent and they want to be live full aram se. So they go for the income fund. Okay. Next comes the money market mutual fund, which aims at maintaining capital preservation. It is nothing but a liquid fund. You see, these educational institutions who will be having bulk admissions. So they want to keep that admission amount for some days for some purpose. So instead of keeping that amount idle, what they do is they invest in the liquid fund. So what will happen? There the capital will not be loosed. The capital preservation will be there. So there from day 1 to 91 days period of lock-in will be there. Means from 1 day to 91 days you can invest there. You can invest only for, you can do only for 2 days, 5 days, 10 days. For how many days you want to keep, for that much days you can keep, and you can take the return from that. It is same like a savings account only. Fine. So these are some of the funds where you can invest based on your risk appetite. Fine. So next comes the two types of schemes. So one is buy structure and another one is other schemes. So whenever you want to invest in mutual fund, there are two types. One is open-ended scheme and another one is closed-ended scheme. So what is open-ended scheme means? You can invest in mutual fund whenever you want, and you can withdraw from mutual fund whenever you want. There is no restriction to entry and exit. But in closed-ended fund, there will be a lock-in period of 3 years. So now if in 2020 if you invest, then your amount will be blocked for 3 years. So usually NFOs will be there for closed-ended fund. Even in open-ended fund, NFO will be there. But if in open-ended fund, if you invest, you can enter and exit anytime, whenever you want. So this is the difference. And some other schemes, like there are some tax saving schemes which are beneficial for you for the tax exemption, ATC, under section ATC. And some special schemes are there which are like retirement plan. As you know, nowadays in private sector you won't get retirement pension. So you can opt for the retirement plan, which is very good and it will work out very well. And next one is the child plan, which is very much essential, as nowadays the education expenses have grown up like anything. Now, when we were studying, it was 10,000. Now the college fees for PUC is become 1 lakh. So you can just think of it. So special schemes are like retirement plan and child plan. And next one is the sector scheme. Sector schemes means they will invest in a particular sector like pharma sector or infrastructure or banking. So if you select that particular sector, then they will invest only in that particular sector. Fine. Now next comes the difference between the lump sum and the systematic plan. So whether you should go for a lump sum or whether you should go for a systematic plan. So there are two types. Lump sum means you will just invest the amount and you will just leave it, but you have to invest when the market is low. In systematic investment plan, you will have a chance to enter during different market cycles. Now you can see there is a lot of fluctuation in the market. So at this situation, the systematic investment plan will work out better than the lump sum. And then in lump sum, at least minimum 5,000 you have to invest, and in a systematic investment plan with 500 per month you can start investing. It's like a pocket money how you used to do when you were a child. Then in lump sum there is no average cost. In SIP there is an average cost. Okay, and in SIP if you start doing, then you will start the habit of saving. But in lump sum you will not do that. So how the systematic investment plan work out is, every month you will invest 1,000 with different NAVs, and then you can see the units here will be brought with different rates. So on an average cost purchase per unit will be 11.08. So if you go through the systematic investment plan, then this will work out, because if on first month of January, if you invest 5,000 rupees, the NAV was 12. And if you go and invest every month, then the NAV will become 11.08. What is NAV? Is net asset value, which is the price of that particular mutual fund companies. Like in shares, how there is a current market price, in the same way in mutual fund it is termed as NAV. Conclusion is similar to regular putting money into the piggy bank. In the same way you will be doing it here. One of the most popular tools for long-term wealth creation, similar to building your dream house brick by brick. How do you build your home? In the same way, you will be building your wealth. Okay. So SIP allow an investor to invest a fixed sum of money periodically into the equity mutual fund scheme. Since most of us calculate our cash inflow and outflow on monthly basis, the simplest way to plan out our investment on monthly basis. So SIP always work better than the lump sum, because you will be safe when there is a over market fluctuation, and you need to have you need not have to monitor the market all the time. Okay, fine. So I hope you got an idea of where to invest, which are the financial instruments where you can invest. So start investing and grow your money. Okay, so please do share and subscribe our channel and comment for our channel. Thank you. Happy investing.